So as I always say at the start, sometimes it's true, sometimes it's not. Hoping to make this a fairly quick webinar here, get the kind of key points across without wasting too much time. But I am going to go live into the platform towards the end, so that's something that sometimes can drag out a little bit. As you know, the topic of today's webinar is steps to follow before entering a trade. So the key emphasis being here before entering the trade. A mistake a lot of people make is that they're trying to do too many things at one time, namely at the very moment they want to place a trade, they're going through the whole sort of analysis, mental preparation, everything happens all at once, and it can be a little bit difficult to manage. The idea here is to have a few steps that you follow before you place a trade, just to make the whole thing a lot more formulaic and a lot more reliable. So we're going to just cover the first part here, why do we actually need this pre-trade preparation, just to remind ourselves exactly why this is necessary, because obviously one thing is knowing the steps to take, but if you don't know why you're bothering doing them, then obviously it's a lot less likely you'll actually follow them. And then just another one, just what questions are we actually trying to ask ourselves about the condition of the market and why we'd actually want to place a trade, and then how we would do it. And then I'll just cover those steps and details, and then we'll just swing over to the trading platform and hopefully run through a few examples of how you might make some of these decisions in how to set up your trade. So this is just what I mentioned in the, you may recognize this sentence from the webinar description, but every trader should follow the same precise steps before each trade. This trading routine adds a layer of consistency that can hugely benefit the trading experience. So it's probably a separate webinar to go into how you prepare your trading day if you're a day trader, or how you prepare your trading week if you're a swing trader. That is a slightly separate process. What we're looking at here more specifically is there's a specific trade you have in mind that you want to place. What are the steps that you take before it? Now, the reason I've sort of alluded to this a little bit already, so I'm not going to keep harboring on about it, but you want to be ready for the market. Simple enough point, right? But you know, we can certainly find ourselves in a situation where we haven't properly thought out the trade, we end up risking too much, or we haven't thought about some of the scenarios that could happen that we might expect to see. That can be stressful, leads to the wrong decisions, trades being closed out too early or left open too long. You know, those things are always going to happen, but the key is just to minimize them, to put the probabilities on your side, and oftentimes it is just cutting out a few of these errors that can be the difference between being a break-even trader and a profitable trader. I've alluded to already, it really does help minimize stress if you've got a list that you just check off of things that you need to do before your trade. If you check them all off and the trade goes wrong, we'll say la vie, you've done everything you needed to. Maybe at some point you can modify the list, but you've done all you needed to, so there's nothing to feel stressed about. Whereas if you're sort of forgetting things, jumping in last minute, again, it's unnecessary stress that, fine, being stressed, maybe you can handle it, but if it actually affects the quality of the trade, then obviously you want to avoid it. And I've also kind of alluded to this last point here, is that you kind of want to process here. So if you're just doing things at random and just doing things willy-nilly, trade looks good, jump in, don't really know where the stop loss is, don't know what you're targeting, but the market looks good, jumping on a pullback, you know, market's breaking out, let's jump on the breakout before thinking about it, this kind of stuff. There's not really a defined process there that you're going through. So if that trade works, great, but what was it that you did that made that trade work? Or if the trade goes wrong, what is it that you can actually improve about what you did to improve the chances of it working next time? You don't really know, because there wasn't a process that you can then assess and amend later. So I think I've I've covered all that. So ultimately, what are we trying to ask here? This is really boiling it down to super simple questions, but actually it's really good to keep these in mind. I actually have these printed out next to my screen, just because, again, it's just reminding you what you're actually looking for here. So what has the market done? Number one, looking back to the left side of the chart, what's been happening? What is it doing right now? What is it likely to do next? Is there a trade there where I can take advantage of what I think it might do next? And is the risk on that trade acceptable? I.e., every trade you can win or lose. I always like to think that the next trade that you place is pretty much a 50-50 win or lose scenario. It's just over the course of 10 or 20 trades where your trading edge kicks in. So given the fact that it's a 50-50, you could lose this next trade. Is the amount you're risking really worth it? Is the amount that you could possibly win from the trade, is that worth that risk you're taking? Always worth asking that question. So what are these steps? So this is the bulk of the webinar right here in these steps. So do a screen print if you like, because I've pretty much tried to chuck it all in right here in one page, and then we'll keep referring back to this, but we'll jump into the trading platform. I'm not going to go into detail on point one. I mean, this is more like a personal thing. Some people go pretty holistic on this and start doing yoga and things in the morning, whatever it takes really. But the basic point being that you can't just roll out of bed and open up the laptop and start placing the trades. You can do it. Lots of people do it, but I don't think it's advisable. You're not in the best mental, physical state in order to place a trade at that point in time. Equally, you've had a long day at work, you're absolutely knackered, it's in the evening, then you start eyeing up some trades. Again, you're not mentally at the best spot for it, so just be aware of that. I don't think I need to get into that anymore, but it literally is the first step in the process. So, it's amend. All right, I should amend this slide because amend is spelled wrong. Thank you for that, Dave. That makes sense. So. Now getting more into the nitty-gritty of it, the idea is that you have a certain setup in the market that you are looking for. And once you see that setup or that part of your strategy that you need in order to place a trade, then that's when you start looking at the trade. So I think it's ideal to have a checklist to kind of just go through how the market's behaving right now, as far as the news, and then as far as how it's set up technically to kind of meet the criteria that you're looking for. So it's a different webinar to go into what all the different possible criteria are. I'm going to kind of touch on one, I guess, when I get to the trading platform. But this I think kind of nicely summarizes the kind of things you're looking for. So what news is coming out? If you've got non-farm payrolls coming out in 30 minutes and you're looking at a short-term trade setup, well, you should probably bear that in mind. If you're looking at a longer-term position trade, non-farm payrolls coming out in half an hour, it's not such an issue, but maybe you can get in at a better price based on the NFP, or maybe NFP is going to put you in at a much worse price. So it's worth considering, right? Much more importantly for me, what is the trend? I mean, it's a mistake that I still get tempted into on a regular basis, placing trades that look very attractive, but in the opposite direction of the major trend. So is your intended trade in the same direction as the trend of the market? So where are the major support and resistance levels? So just looking at previous swing highs and swing lows. What is the market doing? Is it just in a speedy trend, or is it in some sort of longer chart pattern, like a consolidation of some form, maybe a flag pattern within an uptrend, or maybe some longer form triangle pattern range kind of situation? That should determine how far you think your trade can go. Are there any kind of candlestick patterns in play? So you may actually be using a specific candlestick pattern as the trigger for your trade. So what is that pattern that you're looking at, and how do you actually play that particular pattern? And then lastly, if you use some technical indicators, what are they saying about overbought and oversold levels? In the case of oscillators, obviously if it's a moving average, it's more just playing into that that second question there, what is the trend? So if that criteria that you're looking for in the market all kind of fits together, you've seen what you think is a buying opportunity, trend is up, it's near a support or it's broken a resistance, chart pattern looks good, candle pattern confirms the move you're looking at, at what price will you enter the trade? So that could either be a current it can be a market price, so just enter right now, or obviously it can be a stop order waiting for a breakout, or it could be a limit order in order to wait for a pullback to a better price. Now, I put these in sort of a 1, 2, 3, 4 type order, but some of these you kind of, you decide one, then you look at the next point, and then actually you have to revise the previous one. So what I mean by that is, what kind of entry will you want to use? Okay, so maybe you decide to use a stop order. But then you have a look at where you need to place your stop loss, and you think, okay, that's fine. Maybe it's 150 points away, and then you look at where the potential profit target is. It's only 100 points away. So then suddenly you're looking at risking 150 points to make 100 points. Something needs to be adjusted. So either you need to just completely abandon the trade, or you need to perhaps adjust where your target is, or where your entry is, or indeed where your stop loss is. So all these things factor in, and that's that point 7, the risk to reward. Is the profit potential worth the risk? If it is worth the risk, then you need to just make sure this trade is doable according to your account size, and you just need to use the risk that you're willing to take on the trade. So if you're risking 1% of a $100 account, obviously you're risking $1. If it's a $1,000 account, you're risking $10. If it's a $10,000 account, you're risking $100. If it's 1% that you're risking, so you need to have that pounds, dollars, euros amount in mind before placing the trade, and then you need to adjust the size of the trade accordingly. So how many contracts you're trading in CFDs, or how many points you're betting in spread betting before you get into it. And then it goes back to where your profit target is, but how are you actually exiting this market? Are you trailing a stop loss behind the market? Do you have one fixed target, or do you have multiple fixed targets, or a combination of? That all kind of all these decisions need to have been taken before you've actually entered the trade. Not like, oh, I'll jump in, this looks good, the market's taken off, let me jump on board. Oh, hold on, where should my stop loss go? Oh dear, it's a bit too, that's probably risking a bit too much, and oh, actually, probably this move isn't going to last too long. This all needs to be decided beforehand to decide even if the trade's worthwhile. And one of the hardest things to do is to actually ignore a trade that you think is quite likely to work out, just because the potential reward, even if it seems quite likely, is not worth the risk that you need to take in order for the pattern to be able to play out properly. So let's jump into the LCG trader here and try and find some examples of this. It'd be great if you have a particular market you're looking at for me to delve into, and then we can try and look at examples that way. Obviously more interesting for you if there is some particular setup that you guys have in mind. Otherwise, we've got a couple pre-planned. Man, I can never do this right. There we go. Okay, let's get us in full screen mode. So this is dollar yen. So a classic example of actually the trend has been pretty much solidly to the downside, right? So a couple of examples in mind. So using candle patterns. So you can see here's a declining trend line. That's the 50-day moving average. That's the 200. You can actually adjust it to. Is that the? Huh. Indicate. Bear with me. Let's change that to the 20. For a more aggressive trend, it makes more sense to use the 20. So there you go. So look at this. We've had a rebound in the market. We've had a sell-off, and we've bounced back again, but we're in an overall downtrend, and we're approaching the moving average and a declining trend line. And then we have a bearish engulfing pattern here. So say this is the particular market setup that we're looking for. So we've looked at the trend. So let's pull up our criteria again if we can. Maybe I'll need to be dragging this in. Oh man. Maybe I better just, oh yeah, if I can make it smaller, that would work, wouldn't it? So we're mentally ready. We've just been for a jog and physically ready, for example. News coming out, well, we've taken it all into consideration. The trend is down. Support and resistance. Well, we've seen there's a big support level up here. We've put in a new resistance at this 107.90. We're below that resistance level, but we're quite close to it. We've got a support right down here, which is 106.50, which is a reason to be a little bit cautious of this particular setup. The chart pattern is that it's pretty much just a downtrending environment. There's you could probably find some other patterns on a shorter term basis. You could argue that this is maybe a pennant or a flag forming in this particular correction. But overall, it's just a downtrend with a retracement so far. What are the indicators saying? Well, I don't have any on the chart right now, but let's assume they're saying that the trend is likely to continue. At what price we enter the trade? So this is our first decision, right? Obviously, this is all the benefit of hindsight. Let's put our pattern that we're looking at here. So we've obviously got the trend in mind. We've got a pullback within the trend. We've got a couple of areas of dynamic resistance where the price is falling away from, and a candlestick pattern, all kind of fitting together to hopefully make this a good trade. So the market's closed. The closing price is down here. Let's zoom in a bit. The closing price is here at 106.70, say. For this trade to really be given enough room to play out, we realistically need a stop loss above the previous swing high, right? More aggressively, it could be just above this high, which is 107.50, or probably more conservatively above this high up here, which is 107.70. So you can see quite interestingly that it's almost perfectly 100 pips from this swing peak down to this close down here. So if we're entering at the close of the market here after this confirmation candlestick pattern, we're risking 100 pips. So 100 pips, and then we have this immediate level of support here. We're not going to target that support, right? That'd be absolutely insane. Or even if you're talking about this level down here, 106.37. It wouldn't be insane, but it's not something I would do. Here's 100 pips that we're needing to risk. Let's get rid of these other levels for avoid confusion. And then from 70 down to say 40 is basically saying that we're risking 30. We're looking to make 30 pips from a 100 pip risk. So if we go back to that, where we've decided where we place our stop loss, we'll decide where to enter the market, we'll decide where to take our profit target down here. Now we're looking at risk to reward. not worth it, right? Risking 100 pips to make 30, you're going to have to be pretty accurate in your trades with sort of 80-ish% success rate to make money from regularly trading these kind of market setups. So then we think, okay, let's assume that the trend is going to continue through that low and trade down to the previous low down here. Even now, we're only looking at 106.70 down to 105.50, say. So that's now about just over a 1-to-1. It's like a 1.2 to 1 risk to reward ratio. Risking 100 pips to make, say, 120, right? You can trade like this. That's certainly possible. Or, you know, a third option would be, okay, let's target some level below this low. So what some people will use is a previous support or resistance level in the past, or a Fibonacci extension. So we could go for something like, we're basically trading on this retracement here. No, hold on. Let's, okay. I feel like I'm probably going to complicate things too much by adding that. Unless anyone's really desperate to see that. But basically, you could do like 123% retracement level, which would maybe take you down to here, down to about 105, and then suddenly you're looking at more like a 1.5 to 2 to 1 risk to reward ratio. The next step is to decide if that's acceptable. Another option here that we should lastly explore is that we can actually adjust where we enter our trade, right? So we just assume that we should enter at the open of the next bar after this pattern. What we could actually do is enter on a retracement of that bar. So if I chuck in the Fibonacci here, you can see that if I leave that level there and I'll move down to the lower time frame, put it on at 4 hours, for example. So this is a bit more granular look at this particular trading bar down here. And you can see we've pulled back right to basically the 61.8% Fibonacci level. So we're we're tracing just under 2/3 of the prior move, bit over 60% of the previous move, obviously, before the market rolls over again. Another option, obviously, is even if you traded at the 50% retracement, you know, you wouldn't have timed it perfectly as well as the 61.8, but you would have been a bit more likely to get in the trade. But if we put in our line there, let's say the 50 or even the 61.8, which is there, and we go back to our daily chart, we can see that we've adjusted our risk on the trade from 107.16 up to 107.68. So actually now the risk on the trade is about 50 pips. And depending on our target, we could even start to realistically target this level down here, or this level down here. Suddenly it's 50 down to from 107, say 20 down to sort of 105.50. You're talking about 170 odd pips, right? So that's suddenly a lot more favorable. That's a more than 3 to 1 risk to reward ratio. So suddenly the trade's looking a bit more attractive at this point. Then maybe you're happy to enter in the trade. So now at this point, from originally having decided to use a market order at the close, you've now decided to use a limit sell order up here after seeing this daily candlestick. So you've seen this daily close, you set your limit order up here, and then you hope that the market actually gets up there to touch it. And you place at the time of entering your trade, you place your stop loss up there. So let's just go through. Obviously, this trade is already played out, but let's just have a little quick show how we do that. So create new order in dollar yen. So we would literally be just based on our account size. We need to work out the size of our trade, but we can also pan out our levels here. So originally we were thinking about a market order, right? But really, actually, now we've decided we want to place a limit order instead. So the entry price we've decided was 107, call it 15. 107.15. We don't want to put any particular expiry time on this, but we do want to add a stop loss. We've worked out our stop loss using price levels rather than any particular percentage amount. So we're putting that at 107.70. Whoops. It was set as a buy, so now we've got it set as a sell. Now everything's all lined up. Apologies for that. So probably should just go through this whole dealing ticket in order. You set this to be a sell limit, obviously, rather than the buy. Hence, it's good that the platform stops you placing a buy limit, obviously, instead of a sell when you intended. I was trying to put my stop loss above a market order for a buy limit, so obviously that's not going to work. Now it's all kind of lined up. Risking 55 points to make 160, 3-to-1 profit ratio. We're happy with that. Now it's a matter of deciding the amount we want to risk. So here you can see quite handily that it's showing you, based on the size of the contract that you're trading, how much you're going to be risking. So if we just change the size of the contract from 1K to say 5K, we can see that the risk in dollar amounts has gone up from 5 to 25. So we're literally just going to adjust the size of the contract we're trading according to what we're comfortable with. So if you remember, assuming that we had we wanted to risk 1% of our account, and say that we had, say we had 10,000 in our account, then in fact that's when we're going to be risking the $100. Obviously, if we wanted to risk 10% of our account, we'd only need $1,000 in our account, we'd be risking 100. But a typical rule of thumb here, guys, I'm sure you've heard it before, is that it's got to be really it's got to be in that 1 to 3% risk ratio, 1% risk area. Because then if you do have a string of losses, it does happen, 5, 6, 7, 8 losses in a row. Obviously, that's the bulk of your account if you're risking 10% each time. If you're risking 3%, it's not. So we decided what size we're placing. We decided how we're going to exit the market, how we'll take profit. It's all lined up. Place the trade, and then ideally, because we've done all this in the kind of calm before the storm, as it were, before the market started moving. The trade's all pre-planned. Really, we don't ideally want to be adjusting this. We want to just leave it and let it play out, because we've already predetermined all the risk that we're willing to take or the reward that we're looking for. Place order, and there it is. We've got our orders in place down at the lines we decided. So obviously this particular trade worked out. A recent example that I talked about in this week's webinar, which is starting to look a little bit dubious. We're literally on the borderline of whether this works or not, is this particular setup here. Obviously the trend is down. We've hit an area of support. It's near quite an important long-term level, which is 105, but we're actually at 105.50 more like. And then the market rallied well off the lows, forming something akin to a double bottom pattern, came back down, rallied strongly off that low again, and then formed this particular little pattern here, which is like a Pinocchio bar, and then it subsequently broke to the top side. So the trade was looking good then, but it's looked distinctly jittery since. Over the last couple of days we've seen some quite long rejection patterns. So is this an example of a counter trend trade? And again, it's one of those where there are multiple ways of entering the trade. You could have had a buy stop order either above this right eye here or above this left eye. If you'd chosen the left eye, you'd be a bit more, there'd be a bit more confirmation of the breakout. It coincided with the trend line, but we've stalled out, and depending on where we are at the moment, you're sort of right at break even, having been at a decent profit at that point. Had you waited for a retracement somewhere into this point down here, you never would have got it, right? So even though you'd have improved your risk to reward ratio, you never would have entered the trade. Actually, the idea with this, after these first two candlesticks, is that this third candlestick shouldn't dip below this low here, and it didn't. It just about held it. So if you'd waited for the first two candles and then placed your order right down here, you could have an extremely small risk, literally risking like 10 odd pips for a potential explosive move into a new trend, depending on where you're setting your target. So then again, we've reversed off this same level that we were setting our stop loss for this reversal trade. Probably no coincidence that actually this is where the market reversed from again, and sent us much lower. So if we'd had that as a profit target, we'd already locked it in. If we'd had these old highs up here, we're basically sitting in kind of unknown territory at the moment, or sitting around break even. And then the question is, do you move your stop loss up and down? So say you originally had your stop loss under here, do you trail it beneath the daily lows? If so, maybe you'd already been stopped out at a small loss up here, or otherwise you're still holding your stop loss down here, waiting for that bigger move. So these are all the kind of considerations that you place, that you decide before entering your trade, with the knowledge that these kind of scenarios can happen. It can either be very straightforward, just drop straight into your profit target like this, or often, as the case is when you're trading counter trend, it's a little bit more choppy before the trade eventually works out or fails. So you've got to be aware that this kind of action happens, and how do you deal with it? That should all be decided in these steps that we outlined before. So as a reminder, these are the steps. But I think, at this stage in the game, we're slightly 5 minutes over. Been about 35 odd minutes in the webinar, so I think unless anyone has so many kind of key questions on this, I think the next step, if you haven't done so already, is open up a demo trading account or a live trading account and test some of these ideas. Thank you very much for watching this, everyone. I hope that was useful. Some of the steps that you need pre-trade, just to limit your risk, give yourself the best opportunity, and give yourself a proper process for judging and improving. Thanks everyone. Good luck trading for the rest of the week. It's Jasper signing out.